Hey there. If you're a military family or a veteran, you already know the VA loan is incredible. Zero down payment. That's a massive win. But here's the deal. Zero down is not zero cash. The closing costs are still there. Title fees, appraisals, lender fees, prepaid taxes, they can easily add up to $5,000, $8,000, or more. And they sting right before you close. I'm ReAnn Gonzalez with Edge Home Finance, and I specialize in helping military families navigate this process. Today, I'm giving you the 3 VA-specific strategies to slash or even eliminate that cash to close. This is the rule most buyers and agents underuse, and it can save you money. Okay, so now let's get into it. The first thing we need to address is the VA funding fee. This is a mandatory charge that goes directly to the VA to keep the loan program running. It typically costs anywhere from 2.15 to 3.3% of your total loan amount. For a $400,000 loan, that's immediately an $8,600 cost on day one. But here's the fix. If you have a service-connected disability rating from the VA, you are exempt from this fee. Period. It's a non-negotiable waiver. You need to verify your VA disability status early. Your certificate of eligibility, or COE, must show that you are exempt. If you have a pending disability decision, we need to hold that loan until the status is confirmed, because getting the closing done and then trying to get a refund is a long, painful process. This one step alone can save you thousands. Now, let's talk about the rest of the costs. Even after potentially waiving the funding fee, you still have real closing costs. The title company, appraisal, and prepaid escrows for taxes and insurance. This is where the VA's generous concession rule comes into play. The VA allows the seller to pay concessions up to 4% of the home's price, plus all of your reasonable closing costs. Let me clarify. This 4% is separate from the standard closing costs. It can cover things like prepaid taxes, homeowners insurance, and even points to buy down your interest rate. Here's the deal. On a $350,000 home, 4% is a potential $14,000 in coverage. You have to coordinate with your real estate agent to structure the offer correctly. In a buyer's market, you can simply ask for the credit. In a competitive market, you might raise the purchase price slightly to accommodate the concession, as long as the appraisal supports that value. The math never lies. We need to model this out before you even sign the contract to ensure you are covered. What happens if the seller won't pay the full 4%, or if you're in a market where asking for concessions is difficult? You still need cash relief. The third strategy is a strategic trade-off, the lender credit. You accept a slightly higher interest rate, and in return, the lender gives you a credit that goes directly toward your closing cost. For example, an 8% higher rate might yield you $2,000 or $3,000 in credit on a mid-size loan. This is a decision about liquidity versus long-term costs. If you need that cash today to furnish the house or cover moving expenses, taking the credit might be the smarter financial position, especially if you plan to refinance when rates drop. The mistake I see is taking the maximum credit without checking the total lifetime cost. We always look at the break-even point first. Prioritize liquidity first, then worry about the long-term rate. The ultimate goal is to stack these 3 strategies for a 0 to low cash closing. Confirm the waiver. Get your COE showing exempt status immediately. Number 2, negotiate the credit. Align with your agent to include a seller concession, ideally up to 4%. And number 3, fill the gap. Use a modest lender credit to cover any remaining costs. You now have a clear legal path to save thousands. If you are a military family or an agent working with one, don't leave this money on the table. Reach out. I'll map your numbers and negotiate the structure that protects your cash on day 1. I'm here to help you navigate every step of the way.